everyone, and welcome to the Financial Horse Podcast. Today, we have with us Mr. Christopher Lee, CEO and Director of ShareInvestor. So in your investing experience to date, what do you think would have been your biggest mistake? And any lessons that you had?
I think investing is a journey. You have to try, and if you don't try, you won't know. So you can read, you can learn from others, and but nothing beats really putting your money down and experiencing that journey. So yes, I've learned a lot over the last maybe 20 years or so, right, that I've been investing. There are ups and downs. I've got some very good returns, and of course on the other end, I do have a few investments that really go very bad, and I ended up losing quite a bit of my money. Yeah.
At Financial House, we have a lot of young readers who keep asking us, what is the best way to invest? What advice do you have on starting investing? So if I were to pose this question to you, what advice would you give to a 25-year-old Singaporean investor today who's looking to start investing?
I think the first thing that investors should do at that age is really to be inquisitive and start looking at the various approaches to investing. You can read, you can learn from others, but like what I said previously, after you have done that, you must take action. So some people actually read a lot and they talk to a lot of people. Then after that, they have formulated certain so-called thinking, and then they say, okay, let's wait, and then they go back to their daily routine and they forget to invest. So I think having the knowledge is important, but taking the first step is even more important. So if you are young, working adult now, I suggest you spend some time to really know about different approaches and talk to people, and be prepared to set aside money to invest in the market. Okay, whether is it listed so-called equity, a structured instrument with an underlying equity, or for that matter a bond, but take the first step. And you don't have to invest a lot of money, right? Especially when you're just starting off at 25, probably just graduated, and you have got a modest so-called a salary, and you have got so many other things to worry about financially. But do allocate a portion actually of your earnings into investments, because the returns over the longer term, as proven by so many different great investors in the world, that actually gives you a much better return as compared to you do passive saving. For typical investors, you will find that they may not have the luxury of time to really analyze. So if you're in that situation, you probably may be better off buying an ETF that the underlying maybe, let's say, the STI, right, the component stocks. So yes, that's a good way to start off. But as you get more and more well-versed in investing, it will be actually encouraged for you to look at the sector, and then or the macro, the sector, then after that zoom in into stocks that potentially can give you the upside. I think during the time when I was investing, when I was younger, there were so many growth stocks in Singapore that can give me a multiple bagger, right? So I've got some good runs with some of those. But nowadays, it's probably a bit more difficult to identify these multiple baggers. But that doesn't mean that there is no such opportunity. It's a question on whether do you have the time and the discipline to look into the market. That's why over in ShareInvestor we started the Investor One portal, whereby we help investors zoom in into the catalyst company. These are stocks listed on the second board, and based on my experience and also based on what I've seen on the Investor One portal, there are some pretty interesting and promising stocks that can give you a multiple bagger over a period of time.
So actually on that note, with all that years of experience at ShareInvestor, at IBM, and investing in the markets, what would be one piece of advice, one key lesson that you've learned in all this time?
Okay, I think if you're talking about investment, right, one
Yeah.
key lessons in investment, right, I think is to really invest into something that you know. Okay, that's why one of the phrase we have in ShareInvestor is that invest with knowledge. So you can start off by learning by investing in a diversified portfolio through an ETF, or you want to put money across a few blue chip. I think that's okay, but you will only get a very a defined or solid return if you invest with knowledge. And so it is important to know what you are investing into, the company, the management, the prospect. Also to understand that in the event if there are some development, let's say macro development, how is it going to affect the company? So these are things that you need to think through, before you put even more money into that investment. You can choose to put a little bit of money into each blue chip that let's say not that much, or you can choose to put a bit more, or in fact a lot more money into something that you really know very well. So how you want to approach it is, I think it differs across individual. For me, I've learned to say that I will focus now. Although I have a portfolio of some blue chip company, but I am putting money into the business that I know a lot. Like for example, in ShareInvestor. That's why I did the management buyout. So as compared to if you buy a diversified portfolio of a blue chip, they are very good company, but internally each of them has their own set of problems, right? Depending on the macros, whether is it in the airline, healthcare, or for that matter, the tech industry. So nothing wrong in diversifying, and especially if you feel that, let's say, 6 to 8% return is good enough for you. So it really depends on your expectation also, right? If you feel that 6 to 8% is good enough for you, I think the REITs market in Singapore will probably be able to deliver that with a pretty managed risk in your capital preservation, right? But if you are hoping to get, let's say, something in the range of, let's say, 15% or even more than that, right, then you will probably have to really invest in things that you really know, and of course the risk level will go up correspondingly.
What do you think will be the dominant theme for investing in Southeast Asia over the next 10 to 15 years?
I think today the market cycles are much shorter, but I would say that in the next maybe 3 to 5 years, that the ASEAN potential, is still there. It is still a tremendous investing opportunity for investors in this region. With the likes of the Thai market and the Indonesian market being very exciting. You may like to know that over the last 5 years the Thai market has really grown significantly, in terms of its market cap and the volume of trade. So I still see that there will be investment opportunity on the equity market side in ASEAN, particularly in Thailand and in Indonesia. Now Singapore, I think as a financial hub, right, and as a key capital markets whereby we attract a lot of foreign direct investment, it is in a way I would say more matured as compared to the rest of the ASEAN market. So Singapore will still has its attractiveness, like for example the REITs company and some of the blue chips. But when it comes to a growth company, as compared to maybe Thailand or Indonesia, I think Singapore will be a bit lacking in that sense. So it really depends on what will be your investment appetite. If you want steady blue chip return, Singapore still give a very good selection of stocks. But if you're hoping for a multiple bagger, a high growth company, Singapore will probably have limited opportunity as compared to those that I've seen in Indonesia and Thailand. Yeah. And Vietnam, is something that is also very exciting. I just came back from a trip in Hanoi just 2 days ago, and I can see that the people there are very hungry, very fast-paced, very IT savvy. So there will be opportunities actually for investment in Vietnam. The question is like whether with the infrastructure, and the processes, be ready actually for investors to go in the next couple of years, because the foreign direct investments are going in already. So investors, as individual investors, how do you assess the market there? What are some of the proxies that you can use? I think that is an area that investors can look into. But I'm not saying that you should jump in immediately. I think they still probably will require a couple more years before it will be a bit more open to retail investors, foreign retail investors going in today. Over the last 13 years, I've been doing business in Thailand, and I've looked at the growth of the capital market and the returns that it has given to investors. Probably is something that is enviable, I would say. The other things that investors should know is that when we invest in foreign markets, there is always this currency risk that we have to live with. And one thing good about the Thai market, if you look at the Thai baht over the last 10 years or so, it has been very, very stable against the Sing dollars. So when it comes to currency risk, the Thai market or the Thai authorities have kind of given that confidence to investors that the currency is very stable. And if you look at the number of listings in Thailand and what are those companies, you'll be amazed that these are not international companies going to Thailand to list, and these are companies that are local, domestic companies that are that's grown over the years, fluid by local consumption. So we are talking about an average of 30 to 40 listings per year in Thailand, and these are good domestic companies that have grown significantly. So I think the investors should first get an account open, whether with a local brokers or international broker that can assess the Thai market. And you got to make sure that your cost of trade is kept low, and with the stability of the currency, I think you can do a lot more research, whether it's Singapore companies, Thai companies, or for that matter Vietnamese company. You must do research. You need to have access to information. That is why in ShareInvestor business we have the market data toolset, the ShareInvestor Station and Web Pro, so that you can assess all the 7 major markets that we provide information on. So I think investors, if you're keen in Thai market, first get yourself equipped with the knowledge on which are the Thai companies, and then again, when you invest, it is the same, whether it's Thailand, Singapore, or for that matter the US. You have to look at the business proper, you have to look at the management, you look at the prospect, and you got to read the annual report, right? And you got to look at the returns over the historical returns. So all this will factor into your research. And of course, in today's day and age, the social media plays also a very big role in educating investors on the potential of the companies. So companies like yourself, Financial Horse, is doing a great job in helping investors to get to know more about companies or approaches to investments. There are other social media and blogs whereby they also educate investors. So yeah, some of this you can supplement your personal research with some of this comment, and then before you make your investment, right? So that applies whether it's in Thailand, Singapore, or for that matter Vietnam and Indonesia. Yeah, I think an average investor should allocate a portfolio into this 3 bucket, whereby you should have some exposure in the blue chip, have some exposure in the growth stock in Singapore, and the growth stock actually in the region. Yeah. But as to how much you should allocate into it really depends on your probably your investment appetite and also your experience in investing. One key lessons is that you must invest in today's environment. If you just based on your career, I say I want to earn X amount of money and become financially independent, at the age of let's say 55, it's going to be very challenging, especially with the high cost of living here in Singapore. So the wage is not going to catch up at a pace at which the cost is catching up here. So therefore, the ability to invest intelligently and empower with knowledge in the longer run will help you, gain financial independence earlier.
Yeah, that's a great point. I actually just want to ask a quick question because there's a lot of talk about how there's a global economic slowdown, how negative interest rate, government debt around the world is at record highs. With all that in play, do you still advise people to continue investing in this climate?
Yes, like I say, if you don't invest, you will have a problem because your dollar you know about the challenge. If you keep a dollar in the bank, it probably worth half 20 years down the road. So you have to invest. So no matter what the macro environment is, the question is the timing. When do you see some of these things may change for the better, and you should invest then, or you feel that now it has reached the rock bottom, and therefore it's a good time to invest. So it's a timing issue. That is why you need to read, you need to find out, and you need to take some views, rather than to say that I just the macros is like that, and therefore I'm going to put my money in the bank and I'm not going to do anything about it. Now, if you adopt this mindset, it's back to my earlier discussion, which is you read and read and read, and then after that then you say I take no action. The arrival of the internet, that has leveled the playing field, and therefore it's a question of whether the individual investors make an effort actually to really study, understand, and take the first step.